Your retirement account is not the worst thing you will leave behind. That is the part nobody says out loud. The message about traditional retirement accounts has finally reached people. Most of you watching already know that leaving a large one to an adult child creates a problem, and that there is a 10-year clock attached to it. What has not reached anybody is that there are 4 other things sitting in ordinary American households right now that are worse. Not slightly worse, structurally worse. One of them hands your child the entire balance as taxable income in a single year, not 10 years. 1. There is no window, no spreading it out, and no planning around it after the fact. One of them is a tax break worth 6 figures that gets destroyed permanently by a single piece of routine paperwork that people sign in the week they retire, usually because somebody helpful suggested it. One of them is a protective structure that families pay an attorney to build, which can accidentally cut the 10-year window down to 5. And one of them is a product sold specifically to older Americans as a safe choice, which is one of the few things you can own that receives no step up in basis at all. Here is the thread running through all 4, and once you have it, you can look at your own list and sort it yourself. Almost everything you own resets at your death. The house, the shares in a brokerage account, the land, the antiques. Whatever it grew by during your lifetime is simply erased for tax purposes when it passes to your family. These 4 do not reset. The tax code calls that income in respect of a decedent, which is an ugly phrase for a simple idea. The tax did not die with you. It followed the money to whoever received it. So this is not a video about which accounts are good investments. It is a video about which containers hand a bill to your family on the way out. 2 things before I start. I am not an accountant, and this is not tax advice. These are general rules with real citations. Your own situation will differ in ways that matter, and every single one of these deserves a controversial with a qualified professional. What I can do is make sure you know what to ask, because most people do not know these conversations exist. And nothing here says these are bad accounts. 3 of the 4 are genuinely excellent things to own while you are alive. The problem is not owning them. It is dying while still holding them without knowing what happens next. My name is Kevin. I read the rules so you do not have to sit with them, and I bring them here in plain English with the actual move attached. If that is useful, subscribe and turn the bell on, because the second item in this video is a mistake people make in the first week of retirement, and it cannot be undone afterward. The first account. And it is genuinely the worst one on this list, which surprises people, because it is also the account the financial press has spent a decade calling the best deal in the tax code. The health savings account. While you are alive, it is remarkable, and I will not say otherwise. Money goes in without tax. It grows without tax. It comes out without tax when you spend it on medical costs. There is nothing else in the tax code that does all 3, which is why people were told to treat it as a retirement account. Pay your medical bills out of pocket, let the balance compound, build it up over decades. A lot of you did exactly that, and it worked. Now here is what happens when you die holding it. If your spouse is the named beneficiary, nothing happens. It becomes their account, it stays a health savings account, no tax, no distribution, no event at all. That path is clean. If anybody else is the beneficiary, and that means a child, a grandchild, a sibling, a friend, the account stops being a health savings account on the date of your death, not on the date they withdraw it, on the date you die. And the entire fair market value of it becomes taxable income to that person for that tax year. Read the shape of that against what you already know about retirement accounts. A traditional retirement account gives your child 10 years. It is not generous, but 10 years is enough room to plan, to spread it across brackets, to avoid the worst of it. The health savings account gives them 0. There is no 10-year rule here. There is no stretching it over a lifetime. There is no rolling it into anything. The whole balance lands on one tax return in 1 year. So a person with a substantial balance can push their child into the highest bracket in the country for that year, on money the parent spent 30 years carefully not spending. And the reason almost nobody knows this is that the entire public conversation about these accounts has been about how to build them. Contribute the maximum, invest it, do not spend it, let it compound. Every piece of that advice is about accumulation. Not one piece of it is about the exit. And I want to sit on why that happened, because it is not an accident, and it is not anybody being deceptive. Think about who talks to you about an account like this over a lifetime. The employer setting it up at work, the custodian holding it, the financial press writing about how to use it well. Every one of those parties is engaged with the account while you are alive and contributing to it. Not one of them is present at the end. The people who deal with what happens afterward are estate attorneys and accountants, and most people never sit down with either until something has already happened. So the information about building these accounts is everywhere, delivered constantly, by people with a reason to deliver it. The information about leaving them is nowhere, because the moment it becomes relevant, the relationship is over. That is the structural reason a person can do everything right for 30 years and still hand their family a problem. Not one link in that chain was ever responsible for the last page. Harlan is 79, and he was proud of that account in a way he was not proud of anything else he owned. He had been a hospital maintenance supervisor for 31 years, and he understood medical costs better than most people. And when they explained the account to him at work in the early 2000s, he understood immediately why it was a good idea. So he did the disciplined thing. He paid every doctor bill out of his checking account, every prescription, every copay. He kept the receipts in a shoebox because somebody told him you could reimburse yourself later, and he never did. He built it to a number he was quietly delighted by. His son is a supervisor at a distribution center and does perfectly well, which is the problem. Add that account to that son's income in a single year, and a large piece of what Harlan built goes straight to Washington. Harlan did nothing wrong. He followed the advice exactly. Nobody who gave him the advice ever mentioned the last page of it. That gap between the advice about building something and the advice about leaving it is exactly why the quiet rules exists. Not clever strategy. The plain sorting of what you own into what resets at your death and what does not, in large print, so that a lifetime of discipline is not undone by a beneficiary line nobody explained. Reading it costs you one afternoon. Not reading it costs somebody else, later, at a point where nothing can be changed. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not put something in your hands you did not already have, send it back. Now, what to actually do about it? Because there are 3 real answers and Harlan can still use all of them. The first is the shoebox. Every unreimbursed medical expense you have paid out of pocket since you opened that account, going back years, is still reimbursable to you. There is no deadline in the law. If you have receipts, you can withdraw that amount tax-free, today, at any age. That is the cleanest way to bring the balance down while you are alive. It is not spending money. It is collecting money you already spent. The second is to simply use it. If you are past 65, withdrawals for non-medical purposes are no longer penalized. They are taxed as ordinary income, the same as a retirement account withdrawal, but there is no penalty on top. So if the balance is large and your bracket is low, drawing it down deliberately during your own lifetime, at your rate, is very often better than leaving it to be taxed at your child's rate in one lump. The third is the relief valve for whoever inherits it. And somebody in your family needs to know this because the window is short. The taxable amount is reduced by any of your qualified medical expenses that the beneficiary pays within 1 year after your death. So if there are unpaid medical bills when you go, and there very often are after a final illness, the person inheriting the account can pay them from it and remove that amount from their own taxable income. 1 year. And it requires knowing the rule exists at the exact moment nobody is thinking about tax rules. So the practical instruction is to tell that person now. Not to leave it in a folder, tell them. And on the receipts, because this is the part people dismiss and it is worth real money. There is no time limit in the law on reimbursing yourself. An expense you paid out of pocket in 2009 from an account that was open at the time is still reimbursable today. The only requirements are that the account existed when the expense was incurred and that you never claimed it as a deduction elsewhere and never had it reimbursed by insurance. What counts is broader than most people assume. Doctor visits and prescriptions, obviously, but also dental work, eyeglasses and contact lenses, hearing aids and their batteries, mileage driven to medical appointments, and in many cases long-term care premiums up to an age-based limit. That last one matters enormously for this audience. Long-term care premiums are frequently one of the largest ongoing medical costs a person has, and a great many people paying them have no idea those payments can be reimbursed from this account. So the exercise is genuinely worth an afternoon. Go through what you have kept, add it up, then withdraw that amount, tax-free, and use it for whatever you like. Because once it is reimbursed, it is simply your money. You have not gained anything you were not owed. You have moved money out of a container that would have taxed your family into one that will not, and paid nothing to do it. And there are two more things about this account worth knowing, because they change what a sensible plan looks like. The first is what happens if you never named anybody. If there is no beneficiary on file, the value is taxed on your own final return rather than on somebody else's. That is not obviously better or worse, it simply changes who pays and in which year, but it is the outcome nobody chose, and it happens constantly, because these accounts are opened at work and the form gets filled in once and never looked at again. The second is a genuine planning idea that almost nobody hears. If you have a charitable intention of any kind, this is the single best account to give from at your death. A charity pays no income tax, so naming a charity as beneficiary of a health savings account means the full balance arrives intact, while the same charity receiving cash from your estate would have cost your family nothing extra either way. Put plainly, if you intend to leave something to a church or a cause, and you also hold one of these accounts, the account is the thing to leave them, and the brokerage account is the thing to leave your children. Same total, different containers, and the difference can be enormous. That is the sort of reallocation that costs nothing to do. No product is sold, no fee is generated. It is two beneficiary forms changed on an ordinary Tuesday. The second account. And this one is not really an account, it is a decision, and it is made in the first week of retirement by people who have no idea they are making it. Company stock inside a workplace retirement plan. If you spent a career at a company that put its own shares into your retirement plan, and a great many people watching this did, there is a provision in the tax code written specifically for your situation. It is called net unrealized appreciation, and it exists in Section 402 of the Internal Revenue Code. Here is the ordinary path. You retire, somebody helpful suggests consolidating everything, and the whole plan gets rolled into an individual retirement account. Simple, tidy, one statement instead of two. And in that moment, permanently, the tax break is gone. Here is what you gave up. Suppose those shares are worth a substantial amount today, and the price you originally paid for them, back when they went in, was a small fraction of that. The difference between the two is the appreciation that happened inside the plan. If you roll it into a retirement account, every dollar of that, the original cost and all of the growth, becomes ordinary income when it eventually comes out, at your rate or at your child's rate after you are gone. If instead you take the shares out in kind, meaning the actual shares move to an ordinary brokerage account rather than being sold, you pay ordinary income tax only on the original cost. And all of the appreciation is taxed at long-term capital gains rates when you sell, which for most people is meaningfully lower, and in some brackets is nothing at all. Same shares, same company, same date. Two completely different tax outcomes, decided by which box somebody ticked on a form. And it is worth understanding why this provision exists at all, because it is not a loophole, and it was not an accident. Employers used to pay people partly in shares of the company, inside the retirement plan. Congress recognized that if all of that growth were taxed as ordinary income when it came out, it would be treated far more harshly than the identical shares held by somebody who simply bought them on the open market. So the code allows the growth that happened inside the plan to keep its character as investment growth rather than being converted into wages. That is the entire logic. It is not aggressive planning, and it is not a shelter. It is the tax code declining to punish somebody for having been paid in shares, which is also why so few people use it. It applies to a narrow group, it has strict mechanics, and there is no product attached to it. Nobody sells you net unrealized appreciation. It is simply a way of taking your own money out of your own plan, and the firm helping you consolidate earns nothing by mentioning it. Now the rules, because they are strict and unforgiving. It requires a triggering event, meaning separation from the employer, reaching 59.5, disability, or death. It requires a lump sum distribution, meaning the entire balance of the plan leaves in one calendar year, and the shares must move in kind. If they are sold inside the plan and the cash comes out, it is gone. That one calendar year requirement catches people. If the stock transfer settles in late December and the remaining cash lands in early January, the lump sum requirement is broken and the treatment is lost on all of it. And you can split the destination. The company's shares go to a brokerage account, everything else rolls into a retirement account. That is completely permitted. Both just have to happen in the same year. There are two more things worth knowing before I go on, because they decide whether this applies to you at all. The first is that this is not automatically the better choice. It depends entirely on the ratio between what the shares originally cost and what they are worth now. If the original cost is a small fraction of today's value, the advantage is enormous. If the original cost is most of the value, meaning the shares have not grown very much, an ordinary rollover is frequently better, because you would be paying ordinary income tax now on nearly all of it for very little benefit. So the rule of thumb is that this matters most for people who worked somewhere a long time and whose shares went up a great deal. If you were at that company for 8 years and the stock is flat, this is probably not your issue. The second is the risk nobody mentions. Taking this path leaves you holding a concentrated position in one company's shares in a taxable account. If that company has a bad decade, the tax saving can be wiped out entirely by the share price. Tax efficiency on a falling asset is not a victory. So the honest version is that this is a genuine opportunity that is genuinely not right for everybody, and it requires somebody running your actual numbers. What is not defensible is having the decision made for you, by default, by somebody helping you tidy up your paperwork. One more mechanical point, because it is the one that trips people who do try to use this. Required minimum distributions come first. If you are old enough to be taking them from that plan, the distribution for that year has to be satisfied before the lump sum distribution happens, and the whole thing still has to complete inside the same calendar year. That sequencing catches people who start the process in the autumn. Between the required distribution, the in-kind transfer of shares, and the rollover of everything else, 3 separate transactions have to clear before the 31st of December at institutions that move at their own pace and slow down over the holidays. So if this applies to you, it is a spring or summer decision, not a December one. Starting in November is how people accidentally break the rule they were trying to use. Truett worked at the same plant for 34 years and retired on a Friday. The following Tuesday, somebody from a firm rang him and offered to help him consolidate. It sounded sensible. He had 2 statements arriving, and he had never especially enjoyed paperwork. He signed. Everything went into one account. It took about 20 minutes, and he felt organized afterward. And nobody in that phone call mentioned that a substantial portion of what he had just moved had been eligible for a completely different tax treatment, and no longer was, and never would be again. There was no reversing it. There is no form for undoing that. It is one of the few decisions in the entire tax code with no second chance in it, and it is made routinely in the first fortnight of retirement by people being helped. That is precisely what the guide is built to prevent. The short list of decisions that cannot be undone, and the words to say before signing anything, in plain language and large type, so that a 20-minute phone call in the first week of retirement does not quietly cost more than a year of income. Nobody rings you afterward to tell you what happened. Same place, kevinexplains.shop, in the description and the pinned comment, and the code is on your screen if you are watching on the television. 7-day guarantee, every single time. A man who did the tidy, sensible, organized thing 4 days after finishing a 34-year career. And there is one thing to do about it if you are still working, or newly retired, and it costs nothing. Ring your plan administrator and ask one question. Does my plan hold employer securities? And if so, what is the cost basis of those shares? That is it. That is the whole call. Cost basis is a number they hold and are required to tell you, and it is the number that decides whether any of this matters to you. If the answer is that there are no employer securities in the plan, this section does not apply to you, and you can stop thinking about it entirely. If the answer is that there are, and the cost basis is a small fraction of the current value, that is a piece of information worth thousands and possibly far more, and it belongs in front of a tax professional before you sign a single rollover form. And if you have already rolled it over, I am not going to pretend otherwise. That one is done. But the same question is worth asking on behalf of anybody in your family who has not retired yet, because this decision is made at the same moment for everybody, and it is made almost entirely by default. And there is one more piece of this that belongs in a video about inheritance specifically. That appreciation does not receive a step up at your death. It is one of the exceptions. So, if you keep those shares in a brokerage account under this treatment and pass away holding them, your heirs inherit the appreciation portion still taxable as ordinary income to them. Which sounds like it undoes the point, and it does not, but it changes the strategy. The version of this that works best is generally selling the shares during your own lifetime at capital gains rates, rather than holding them forever expecting a reset that will not come. That is exactly the sort of detail that decides whether a strategy works or backfires, and it is precisely why this one belongs with a professional rather than a video. The third account, and this one is painful, because it happens to the families who did the most planning. A retirement account left to a trust. People name a trust for entirely sound reasons. A child who is not good with money, a child in a difficult marriage, a grandchild who is still young, creditor protection, making sure the money lasts rather than evaporating in 18 months. Those are real concerns, and a trust can genuinely address them. But a retirement account left to a trust is one of the most technically demanding things in estate planning, and the difference between a trust that works and one that does not is language most people never see. Here's the structure. For the trust to be treated properly, it must qualify as what the rules call a see-through trust. The tax authority looks through the trust and treats the individual people behind it as the beneficiaries. It has to be valid under state law, it has to become irrevocable at your death, the beneficiaries have to be identifiable, and the trustee has to provide documentation by the 31st of October in the year after your death. Miss that documentation deadline and the whole thing can fail on paperwork alone. And then there is the requirement that undoes more of these than anything else. Every countable beneficiary of that trust has to be an individual person. If a charity is named as a remainder beneficiary, meaning whatever is left over eventually goes to a good cause, that charity is not an individual. If the estate is named, the estate is not an individual, and in that case the account is treated as having no designated beneficiary at all, which means the 10-year rule does not apply. The 5-year rule does, or a calculation based on your own remaining life expectancy, depending on your age at death. 5 years instead of 10. Because of a charitable remainder somebody added to a trust document years ago as an afterthought, often as an act of generosity, frequently without the attorney who drafted the trust ever being told the retirement account named it as beneficiary. That is the failure I find hardest to watch, because it happens to the most careful families. Somebody paid for a trust, somebody thought about their children, somebody remembered their church at the end of the document, and those 3 good decisions, combined, cut the payout window in half. There is a second distinction inside this that matters just as much. A see-through trust is either a conduit trust or an accumulation trust. In a conduit trust, everything the trust receives from the retirement account passes straight out to the beneficiary, and they pay the tax at their own individual rate. In an accumulation trust, the trustee may hold the money inside the trust. That sounds like the safer choice for a child who is not good with money, and in terms of protecting the money, it is. But money held inside a trust is taxed at trust rates, and trust rates reach the top bracket at an income level a fraction of what an individual can earn before reaching it. So the structure that protects the money best can also be taxed hardest. Neither one is the right answer for everybody. It depends entirely on which risk you care more about. Here is the practical instruction, and it is one sentence. If any trust is named as beneficiary of any retirement account you own, that is a specific conversation with an estate attorney, and the words to use are these. Does this trust qualify as a see-through trust? Is it conduit or accumulation? And is every countable beneficiary an individual? And a trust that was drafted before 2020 was written under completely different rules. If yours is that old and nobody has looked at it since, it is very likely doing something other than what you were told it would do. And there is a version of this that catches families where nobody did anything wrong at all, which is worth naming because it is the most common one. A trust gets drafted properly. The attorney does good work. The beneficiary designations on the retirement accounts are then filled out separately at a different time, often at a bank branch or online, sometimes years later, occasionally by somebody helping a parent tidy up their affairs. And nobody ever puts those 2 documents side by side. So the trust says one thing, and the beneficiary form says another, and the beneficiary form wins, because a beneficiary designation overrides everything else, including a will and including a trust. Which means the single most valuable 10 minutes in this entire subject is pulling out every beneficiary form you have and reading who is actually named on each one. Not who you think is named, who is written there. People find former spouses on those forms. People find children who have since died. People find a trust named on one account and an individual named on another when they believed both were the same. And every one of those is fixable in an afternoon with a phone call to the custodian. The 4th account. And this one is different from the other 3 because the other 3 are things you built. This one was sold to you. The non-qualified annuity. By non-qualified, I mean one you bought with ordinary savings, outside a retirement account. Money you had already paid tax on, handed to an insurance company in exchange for growth and often for guaranteed income later. An enormous number of people watching this own one because they are sold heavily to exactly this age group, usually on the promise of safety. And while you are alive, the tax treatment is genuinely attractive. The growth inside it is not taxed year by year. Nothing appears on your return until you take money out. Here is what happens at your death. It does not receive a step up in basis. Everything the annuity grew by, over however many years you held it, remains taxable. And it is taxable to whoever inherits it, as ordinary income at their rate, not as capital gains. Put that beside a brokerage account holding the same money. In the brokerage account, all of that growth is erased at your death, and your family inherits it clean. In the annuity, all of that growth is taxable to them. Same money, same growth, same person receiving it, and the difference is entirely the container. And the timing is generally not 10 years either. A non-spouse beneficiary usually has to take it within 5 years, or elect to spread it as a series of payments over their life expectancy. And that election typically has to be made within about a year of the death. So the same account can produce very different outcomes depending on whether the person inheriting it knew about an election deadline nobody told them existed. There is one exception worth knowing. A surviving spouse can generally continue the contract as their own, which defers everything. That path is clean, the same way it was clean with the health savings account. It is everybody else who runs into this. Lavonne is 74, and she bought hers at a seminar with a free lunch in 2009. She had just been through the financial crisis, and she was frightened, and the man explaining it was reassuring, and the word he used repeatedly was guaranteed. And after the year she had just had, guaranteed was the only word she was listening for. It has done what it promised. She has no complaint about the product at all, and neither do I. What nobody at that lunch said, in any of the 90 minutes, was what happens to it when she dies. It was not on a slide. It was not in the conversation. She has 2 daughters, and she has always assumed they simply receive it. They do receive it. They also receive the tax on everything it has earned since 2009, in ordinary income, on a deadline neither of them knows about. Now let me give you the other side of this list because it is the useful half and it is shorter. Here is what does reset at your death. Your house, shares and funds in an ordinary brokerage account, rental property, land, a business interest, antiques, almost anything you own outright that has simply gone up in value. All of that passes to your family with the growth erased. Decades of appreciation, gone from the calculation entirely. Which produces a conclusion that runs directly against everything the financial industry has told this audience for 40 years. For your own retirement, deferring tax often makes sense, because you may be in a lower bracket later than you were while working. For what you leave behind, deferral is the opposite of helpful. The tax you deferred does not disappear at your death. It transfers, at somebody else's rate, in somebody else's year. And the people who told you to defer everything were paid on the balance. Nobody is paid on the exit. So where do I come out on all 4? Not on anybody's motives. I do not think there is a plot here. There is simply nobody in the entire chain whose job it is to explain the last page. The person who opened the health savings account was in a benefits meeting. The person who consolidated the retirement plan was helping with paperwork. The attorney who drafted the trust may never have been shown the beneficiary form. The man at the seminar was selling an annuity, and the annuity was not a bad product. Every one of those people did the job in front of them. Not one of them had the job of asking, what happens when this person dies, still holding it? And the effect of that is a country full of careful people whose care will be partly undone by containers they were never told to look at. Which is the whole reason this is fixable, and I want to end on that rather than on the alarming part. Every single one of these is fixable while you are alive, most of them in an afternoon, several of them with one phone call. None of them are fixable afterward. So, practically, 4 things, and none of them require you to decide anything today. 1. If you have a health savings account, check who the beneficiary is. If it is anybody other than a spouse, understand that the whole balance is taxable to them in 1 year. Dig out your old medical receipts and reimburse yourself, spend it deliberately, and tell whoever inherits it about the 1-year medical expense window. 2. If you have company stock inside a workplace plan and you have not yet retired or rolled it over, do not sign anything until somebody has looked at whether that provision applies to you. Once it is in a retirement account, it is gone permanently. 3. If a trust is named as beneficiary on any retirement account, ask an estate attorney the 3 questions. See-through or not, conduit or accumulation, and whether every countable beneficiary is an individual. If the trust predates 2020, that review is overdue. 4. If you own an annuity outside a retirement account, ring the company and ask 2 things. What is my cost basis, and what are my beneficiaries' options and deadlines at my death? Then write the answer down somewhere your family will find it. And if you are looking at your own list and cannot work out which of these apply to you, email me. The address is on your screen and in the description below. I read every one that comes in. Harlan spent 30 years being disciplined about an account, and nobody ever described the last page of it to him. Truett did the organized thing 4 days into retirement and lost something that cannot be recovered. And Lavonne bought safety at a lunch in 2009 and was never told what safety costs on the way out. All 3 of them were careful. All 3 were doing precisely what they had been advised to do. What none of them had was 1 page telling them which containers hand a bill to the family and which ones do not. And that really is the whole of it. Nothing in this video asks you to understand the tax code or make an investment decision or hold an opinion about anything. It asks you to look at what you own and know which column each thing is in. So spend an afternoon with your own list. Every account, every policy, every deed. 1 column for what resets at your death and 1 column for what does not. It is dull work, and it is the single highest value hour available to anybody watching this, because everything in that second column is still fixable today, and none of it is fixable later. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.